Hi there. Okay, good morning. So, we are looking in this lecture on the cash book and bank reconciliations. Really, the focus is on bank reconciliations. And we have discussed the cash book. We've talked about the cash book as a subsidiary book that is kept in-house and managed by the cashier. And, of course, if you like, the cashier is receiving checks, is writing out checks to pay suppliers, to pay for expenses, but he's receiving checks from customers primarily. And, of course, these checks are being recorded in the cash book, but of course, these checks are going to the bank. And from time to time, the cashier would like to know, or would like to make sure, that the figure that he has in his cash book about what's happening in the bank about what's occurring in the bank is true or is the same. So for example, if he receives a check of 500 and he writes that down, he would like to hope that the bank statement records the check of 500. And so from time to time, what he has to do is to look at the bank statement, to make sure that, if you like, his cash book agrees to the bank statement. Of course, the bank statement would also have things that happen in there that he has no idea about until he actually looks at the bank statement, if you like bank charges and bank interest. Of course, the bank might send him a letter, but that's becoming more and more rare nowadays. It just happens on your bank statement, and your bank expects you to look at that. So, let's begin. So we're really talking about bank reconciliations, and we're talking about this process. It's sort of outside the double entry discussion. It's outside what we've really been talking about. We're just talking about a side issue. Okay, so we're talking about the bank reconciliation statement. And very importantly, the first thing to discuss or agree is that the first thing that a bank rec hopes to do is to agree the balance in the cash book to the balance in the bank. And usually there are disagreements, and usually there are differences. And what we do in accounting is to classify those differences and to discuss them. Okay. So some of the reasons why the cash book and the bank statement might not agree, first of all, might be to do with like some of these things up here. We were talking about the standing orders, right? Direct debits, credit transfers, and bank charges. So I think we're all happy with what a bank. Let me just go onto a normal written screen so I can do some writing and we can discuss these. Okay, so here we are. Oops, sorry. Why the bank statement and cash book will not agree. And the ones I've talked about, for example, are bank charges. Let's talk about bank charges first. Well, what are bank charges? What happens here is that you have a bank account. The bank services the bank account for you, keeps it for you, processes stuff for you. So they charge you from time to time. So this is an expense, if you like, right? This is an expense that your bank, if you like, charges you. Yes, and this, of course, as I say, it's an expense. So, we must record this in our cash book. So what's happened here is that we have something that's happened in the bank that you don't know about. So until you look at your bank statement, you won't know what to do with it, right? And we refer to this, if you like, as a non-timing error. And all the errors I'm going to talk about in this very first section are referred to as non-timing errors. There's nothing to do with the bank processing. Here we just have a situation where you haven't looked. When we come to timing errors, you'll see what we mean. But we're really calling it a non-timing error. All you need to do is go into your bank statement, look at it, and then just go to your cash book and update your cash book. Yeah, update your cash book. On the credit side, of course, you write expenses, you write bank charges, and you update your cash book. Right? And that's what's really happened here. So this is referred to as a non-timing difference. Then we have, there were three others. I'll just start off. The next one was what's referred to as a direct debit. Now, what is a direct debit? We have a situation sometimes where we have a customer, Mr. A, who has Say for example, a gas bill, or sorry, a contract with a gas company to pay them. So for example, let's call this gas company, right? And here's his bank. So what happens here? Mr. A goes to the gas company and says to the gas company, listen, I would like some gas. Can you supply me some gas? And the gas company will, fine, we'll supply some gas. And he says, you know what, I'm willing to pay, I don't know, £20 a month. So we're talking about a regular payment when we talk about direct payments. When we talk about direct debits, we're talking about regular payments, regular amounts. So he goes to the gas company and says to the gas company, hello, you know, I'd like to pay £20 a month. Gas company, fine, no problem. We'll supply you gas and we will charge you £20 a month. So what Mr. A does is Mr. A signs a contract with the gas company, allowing the gas company, authorizing the gas company to go to his bank and take the money out. So it's still an expense that he's paying for gas. It's a regular payment. It's a regular amount. It's a regular expense. He won't know this money has come out of his bank account until he goes and looks at the bank statement. And when he looks at the bank statement, then he'll see the money come out. And when he sees the money come out, then he can record it on the credit side of his cash book. He can update his cash book with this money or this expense that has come out. So this is a gas expense, for example. I mean, it could be a phone company, it could be electricity, it could be any of the above. But the key point here is that this is a non-timing difference. He hasn't checked his bank statement. Go along, have a look at the bank statement, update your cash book, credit your cash book, if you like, with this expense. Okay, really the issue I have here is space. I'm going to have to go to a new page. Yes, and do the others. So we've done so far, we have looked at bank charges and we have looked at direct debits. The next one we look at is what we call a standing order, right? So let's go to the same situation again where we have Mr. A, we have the gas company, and we have the bank. Now, I mean, the end result is the same, but in this situation, a standing order is where Mr. A goes to his bank and says to his bank, you know what, bank, can you pay the gas company £20 a month for the gas they are supplying me? So the key point here is that the relationship is between Mr. A and his bank. Mr. A gives his bank an instruction, an order to pay the gas company £20 a month. The end result is the same, but the difference between the two is that in this situation, Mr. A has not signed a contract with the gas company, but he has just instructed his bank to pay the gas company. I mean, there are legal issues. It's really a legal thing. As far as accounting is concerned, you just need to know, who the relationships are with, but the end result is the same. They are still expenses. Yes, they are still expenses. So that's bank charges, direct debits, standing orders. What do you fundamentally do? Go to your cash book, update your cash book with this amount of £20 as an expense on the credit side. Yes, and that's it. So your cash book is beginning to look more and more like your bank statement, right? Because you're just updating your cash book with everything that's happened in your bank statement. That's our purpose, to make our cash book look like our bank statement. And then we have the final one, which is usually referred to as a credit transfer. For example, someone pays you some money online from their account. Now, you won't know, they haven't sent you a check. So until you look in your bank statement, you won't know that you have received any money from your from the customer if he's paying you online. And that's referred to as a credit transfer. So what do you do again? You go to your cash book and you update your cash book. Yes, you update your cash book. So this is really important. Right, let's go back to the slides and see if we can tie up these ideas on updating the cash book. So here we are again. Yes. we have standing orders, direct debits, credit transfers, and bank charges. We agreed. Standing orders, I mean, really the key point here is either standing orders or direct debits are regular payments, are regular amounts. Typically standing orders, because you're instructing the bank, it's typically sort of, between friends or between whatever parents or, a family, and you're just paying someone. Typically, most companies would prefer direct debit because it means they have the legal authority to go to your bank and take the money. But, it's fine. They're both really the same thing. So we have regular payments set up by the owner of the bank account at the bank to pay someone a fixed amount or a regular amount of money, for example, rent to a landlord. We've talked about direct debits, typically mobile phone contracts or gas contracts, electricity contracts. But here we are. We have here the beneficiary, or if you like, or the gas company, the recipient of the money, is the one who goes to the bank to get the money because you signed a contract, if you like, with them. And this is just money. It could be either way. You could have money coming in, or you could have money going out. But the key point here is that we have online transactions. I mean, another term technically for credit transfers is just online transactions that you need to update your cash book with. Remember, your cash book is sitting in your office, so you're not going to know something's happening online until you check your bank statement. And finally, we have bank charges and interest. Interest, of course, is money coming in. So you update your cash book, debiting your cash book, because remember, your cash book is a subsidiary book discussing an asset of cash or money. And so when it goes up, of course, we debit it. And when it goes down, of course, we credit it. Yes, remember the accounting equation. So, yes. So those are those ones. Right, and we'll come back to, so I think it's important that let's just summarize, yes, just make sure we summarize clearly what's going on here with non-timing differences, yes, to make sure there are no mistakes, yes. So we agree, right, that we have a situation where we could have a difference between our cash book and our bank statement. Yes. Now, one of the reasons for that is what we refer to as non-timing differences. And when we say non-timing differences, we're talking about events that have occurred in the bank that you had no knowledge about until you actually checked the bank statement. And we've given a few examples: direct debits, standing orders, bank charges, credit transfers. There are a couple more we'll talk about in a second. But the key point is that when these occur, what do? We update the cash book. We update the cash book. Yes. So we're going to look at a quick example first, so we actually see what's happening. So let's go here to this is from your textbook 8.2, question 8.2. And here we have a situation where we have a cash book. We're really talking about bank columns, aren't we? Because, it's really, we're dealing with events that are happening in the bank. So we're really talking about bank columns. Here we are, we have your cash book, and then we have the bank statement. Yes. So the first thing we're always going to do, I mean, there are other differences, but I just want to deal with these set of differences first. So the key point, I keep saying this, the key point here is to update your cash book. So I think the first thing we're going to do is, the first thing you should do, I'll introduce it now, is to always tick to see the things that exist in both. First of all, let's just make sure that everything that's in both, the cash book and the bank statement, we're not really interested in those things because those are fine. We're interested in things that are causing our cash book and our bank statement to disagree. Things that are not present in either. And they're not present in one, but present in the other. So let's just quickly agree the things that are in both. So we'll just give them a yellow highlight, so we can see 800 and 800 are there. 800. Then we have let's look here. You have that 100. I can see the 100 here. And that's that 100 there. Then let's see, I see a 398, a 495. Yeah, I can see a 495 here. I can see a 398 as well. 398, let's go up. 398 over here. Let's see, I think we have what else do we have? Is that a 229? I can see 229 over there. Yeah, I see 229. Do you see it? There you go. 229. And a 229. And I can't see these guys here. You see this direct debit here? I can't see that. I'll put that in red. I can't see that. And also I can't see that 716. Yes. So for now, I can't see these two. I mean, I'll come back. I can't see these as well, and we'll come to talk about that in the very next lecture in a second. But as far as the bank statement is concerned, like I said earlier on, we have these events. This is a BACS credit, a transfer of money into your bank account. And here we have a direct debit, a payment, right? These have happened in the bank statement and haven't happened. Of course, you haven't looked at your bank statement yet, just yet. I mean, you're just looking now. So you haven't recorded them in the cash book. So the first thing to do, like I said earlier on, is to update your cash book. So what do? We update our cash book. Now, unfortunately, this cash book has already been balanced, so we can't just go in and insert the figures. We can't rub this out and say, I'm going to rub this out and I'm going to put those in. No. What you do is you need to create, if you like, an updated cash book. So what we do is, you can see the balance carried down, and really the balance, we should write the balance brought down. There's a balance, you know that this balance carried down will come down here as a balance brought down, but we can do that over here. We know it's 415.15. So what we do is we create an updated balance, updated cash book, and we start off, if you like. I mean, it's a cash book exactly. You just create. I mean, you just make it. You build it very quickly. And if you like, let's just do that. So we could call this, yes, if you like, the 31st of January. And balance brought down. Brought down 415.15. That's your balance brought down. Now let's update our cash book. Let's get what our cash book should be. We want our cash book to look like the bank. So it says that we received a credit of 716. It's a good thing. So we credit this. BACS TK Supplies. We're trying to get our cash book to look like our bank statement. 716.50. And also we have this direct debit. I mean, you put the date, use the 31st of Jan. That's fine. And then also we have here as well, the 31st of Jan. We pay out 207.95. Omni Finance. Right, so I'll just double this up, make this 2 zeros. Just to make it look neat and tidy. All right, so that's what we have now. So we have this come in and we have this go out. So we find our new balance carried down. 31 Jan. Yes, of course, which is this side, of course, minus this side. Yes, you're happy with that. You don't have to do that right now. Balance carried down. Yes, which is really this plus this minus this. And we have that. And then we find our totals, add everything down. And everything down. And there you are. This is, let me just make this bold. Underline it. You should get used to doing this in your exams and making your work look really neat. We're looking for A's and A stars. So let's make sure we get that. Here we are. So what do we have? We have a balance carried down there. And I mean, that's really technically really, it's a balance brought down, isn't it? So I can, I'll just copy and paste that for now. Just bring that over here. Ouch, it doesn't like that. Okay. I'll just write it in. 0.70. Okay, right. So you can see very clearly we're happy with our new updated balance as 923. We're getting closer to why these figures are looking closer, but there are still some other differences which we'll talk about in the next lecture when we look at what's referred to as timing differences. But I want you to be comfortable with this first part, which is referred to as the updating of your cash book, with your non-timing differences, which are typically your direct debits, your standing orders, your bank charges, and your credit transfers. Cool. All right. See you in the next lecture.